Hello, and welcome back to the Deep Dive, the only place where we take a mountain of analysis and really distill it down to the essential, actionable insights you need to be truly well-informed.
Today, we are stepping far away from the consumer market and the gadgets you hold in your hand.
Way away.
Yeah, and instead we're going deep into the literal bedrock of modern computing. We are examining the tools that allow this whole AI revolution to even exist.
That's right. Our subject today is Cadence Design Systems, ticker symbol CDNS. For many people tracking this space, Cadence is cited as the definitive pick-and-shovel play for the technology boom.
Exactly. They don't make the chip that wins the race.
Yeah.
But they sell the only roadmap, the only software that lets any chip designer, be it NVIDIA, Apple, Amazon, even get into the race in the first place.
And that positioning, it provides them with phenomenal business durability, especially right now when complexity is just accelerating like crazy.
But, and this is the big but, we have to acknowledge reality here. The market has figured this out.
Oh, it definitely has.
That safety and that quality, they come at a significant price premium.
The stock trades at multiples that don't just anticipate growth. They demand perfection. So our mission for you, the listener, today is critical. We need to unpack Cadence's competitive fortress and understand exactly why its business model is so fundamentally durable.
Right. Then we have to scrutinize the quality of their management, their stewardship, and that financial fortress they've built.
And finally, we have to determine, using a really disciplined approach, whether their immense growth potential, especially around AI, can possibly justify the extremely high price tag the market is demanding right now.
And for you, the curious learner who really wants to get the foundational economics of the semiconductor industry, we're going to extract why Cadence's model is just so profoundly sticky.
And maybe more importantly,
yes, and perhaps even more importantly, we will identify where the market might be missing the subtle long-term risks, the potential permanent impairment factors that could really challenge this valuation fortress.
Let's get into it. Segment 1, the competitive fortress. We have to establish the premise first. When we talk about Cadence, we're not talking about physical hardware. What is it that they sell to the world's most sophisticated tech companies?
That's the essential starting point, and it really highlights their capital-light nature. Cadence sells the digital blueprints, the highly sophisticated electronic design automation, or EDA, software.
EDA.
It's the software suite engineers need to design, to simulate, verify, and lay out these complex microchips and even entire electronic systems.
So you can think of it as like the ultimate CAD software, but for something impossibly small.
Exactly. It's a hyper-specialized CAD/CAM software, but it's tailored specifically for the bizarre physics and intricate logic you need at the sub-nanometer scale.
And the genius of this business model, beyond just the product, is how they make money. How do they structure their contracts? Is it like a one-off sale, or is there something else going on?
That structure is what makes the revenue so durable, so predictable. This is not a transactional one-off sale.
Not at all.
No. Cadence operates almost entirely on a subscription model. We're talking about 85 to 90% of their revenue coming from customers leasing these licenses.
And these are long-term leases, right?
They are, often locked in for 2 or 3 years at a time. This guarantees a highly predictable stream, which, in the super volatile semiconductor industry, is just immensely valuable.
And that's a key reason the market gives them that high valuation, just for the stability alone.
For sure. Beyond the core software licenses, they do have 2 other crucial revenue streams.
Right, the specialized intellectual property or IP blocks, and also hardware for emulation.
The IP segment is fascinating. It's essentially the sale of verified pre-designed components. Imagine you're building a new system on a chip.
All right.
Instead of spending months designing the fundamental protocols for, say, USB 4.0, you just license Cadence's IP block.
Yeah.
It's a verified, optimized block of logic you can just plug into your design.
Which saves incredible amounts of time and risk.
Incredible amounts. And that second stream, the hardware, the emulation and prototyping systems, that's all about risk management.
So this is for testing.
This is for testing the chip's logic and function before you commit to the foundry. If you catch a flaw in emulation, you save time and money. If you don't. Well, that leads us right into their moat. They sell the whole ecosystem. Software to design, IP to accelerate, and hardware to test.
So if we zoom out and look at the structural trend, why is this business model so, intelligible and durable for the long term?
Because they tax the accelerating digitization of everything. It's an inevitable structural trend.
Right.
The underlying force is just the human desire for better, faster, smaller, more efficient tech. Every single device, from a car to a server farm, needs a chip.
And those chips keep getting more complex.
Relentlessly. And as that complexity marches on, the need for Cadence's tools, which manage that complexity, grows right alongside it. They sit at the funnel neck of technological progress. It's a perpetual demand generator.
That structural positioning leads perfectly to the economic moat. When we talk about moats, Cadence isn't just protected by patents. They have one of the deepest, most defensible advantages in the entire tech landscape.
Absolutely. It's built on incredibly high switching costs.
Okay, let's break that down.
High switching costs are Cadence's strongest defense, period. And it's crucial we understand why this isn't just theoretical. It's deeply ingrained in the operations and the human capital of their customers.
So you have to put yourself in the shoes of an engineer.
You have to. Imagine the daily workflow of a chip design engineer at a company like Qualcomm or Broadcom.
Okay, so paint that picture.
Yeah.
Why can't a multi-billion-dollar company just wake up tomorrow, decide Cadence is too expensive, and jump ship?
Because of the decade-plus investment in human training and, even more critically, the legacy code. These engineers spend years, sometimes their entire careers, mastering Cadence's specific interface, their proprietary scripting languages, their unique workflows.
And they're big platforms like Virtuoso and Allegro.
Those are the gold standards. Virtuoso for analog design, Allegro for system design. This mastery is a highly specialized skill set.
So if a company decides to switch, the cost of change is just staggering.
It's staggering. First, you have to retrain hundreds of highly paid, specialized engineers. That's time and money straight out of R&D. But the real anchor is the legacy infrastructure.
The custom scripts.
Exactly. Every major chip design house has literally thousands of custom verification scripts and automation protocols they've built over years, all running on the Cadence environment. You can't just port those. You'd have to rewrite them all.
And in that process, you could introduce subtle, catastrophic errors.
And what's the ultimate price of those errors? It's that terrifying phrase we hear. Tape-out failure.
We need to clarify just how expensive that can be.
It is the existential risk for a chip design company. A tape-out is the final, irreversible step where the design file is sent to the foundry, to TSMC or Samsung, to be manufactured into silicon.
This is after years of work and hundreds of millions in R&D.
Right. And if there's a flaw in that design, maybe an incompatibility missed by an unfamiliar tool, you end up with a manufacturing error that renders the entire batch of expensive wafers useless.
A single tape-out failure, then, isn't just about the money lost on the wafers.
Oh, no. It doesn't just cost tens of millions in foundry costs. It delays a product launch by 6 to 9 months. You could miss an entire product cycle, damage your reputation, and lose billions in market share.
So spending an extra few million on Cadence licenses is just, it's an insurance policy.
An essential insurance policy, which, when a Cadence salesperson is sitting across from a procurement executive, knowing they hold the keys to preventing that catastrophe.
What does that do to their leverage?
It gives them immense, almost unparalleled pricing power. Customers are incredibly risk-averse. They view Cadence not as a vendor, but as a mission-critical partner.
So they'll accept those 5 to 10% price hikes every year.
They readily accept them, just to maintain continuity, reliability, and certainty.
Yeah.
In chip design, reliability trumps cost every single time.
And is this moat staying the same size, or is it actually getting wider?
It is absolutely widening. This is a key insight. The complexity level is just escalating dramatically. We're not just talking about shrinking transistors anymore.
We're talking about moving into 3D.
Exactly. 3D IC designs, where chips are stacked vertically. This creates massive thermal and signal integrity challenges across multiple layers.
Which means you need even better tools.
Exponentially better. The integration required between the different design and simulation tools becomes orders of magnitude deeper. For a customer to try and rip out that fully integrated Cadence workflow for a competitor becomes, well, not just risky, but virtually impossible.
Complexity is the force multiplier for the moat.
Precisely.
Okay, let's pivot to the competitive landscape. This is clearly not a fragmented market. It's often described as a rational duopoly.
That phrase, rational duopoly, captures the structure perfectly.
Yeah.
The EDA industry is dominated by Cadence and its primary rival, Synopsis.
Ticker SNPS.
Right. Together, they control well over 70% of the market. The distant third is Siemens EDA, which used to be Mentor Graphics.
So within that duopoly, how does Cadence differentiate itself? Where's their specific edge?
Cadence has historically been the strong leader in very specific domains. Their advantage has always been profound in analog and mixed signal design.
That's the Virtuoso platform.
That's Virtuoso. It's the interface between the analog world of sensors and power and the digital processing world. It's essentially irreplaceable there.
And their overall strategy.
Their strategy, which they call intelligent system design, is all about tighter integration across the whole workflow, from IP to software to the emulation hardware. They offer a highly sticky full-stack solution.
It's helpful to connect these dynamics to established mental models. Cadence feels like a textbook illustration of what Charlie Munger called the surfing model.
It's the perfect analogy. The Munger model says the best place to be is positioned to ride a massive, inevitable wave without having to predict which individual surfer will win.
Right. Cadence doesn't need to predict if NVIDIA's next chip will beat AMD's.
They don't care. They simply tax the entire industry's R&D spending. As long as that relentless wave of semiconductor complexity continues, and it will, Cadence just sits safely at the toll booth, they profit from the effort of innovation itself.
And the scuttlebutt, the view from the engineers using this stuff daily, it really reinforces this. It sounds like they regard Cadence with a grudging respect.
That's absolutely true. You hear the same things everywhere. The tools are indispensable, but the licensing costs are painful. They complain about the cost, but in the next breath, they'll acknowledge their teams cannot function without these platforms.
Because they're the standard of truth.
They are. And no engineering manager is going to risk a multi-million-dollar tape-out mistake just to save a few thousand on software. It's a powerful dynamic.
That strong foundation brings us cleanly into segment 2. Management stewardship and the financial fortress. For a business to earn this kind of premium, the execution has to be top-notch. So who's running the show?
The current CEO, Enir Divgan, is a crucial part of the story. He holds a PhD in electrical and computer engineering.
So he's a technical leader, not a finance guy.
Exactly. And that represents a necessary shift toward a modern computational software mindset. His core philosophy, which is driving their immense R&D spending, is all about generative design.
Generative design, that sounds like a huge shift, using AI not just to check the design, but to actually create it.
Precisely. Historically, EDA tools were checkers. They verified a human's work. Devgan's vision, especially with tools like their Cerebrus platform, is to use AI to accelerate and automate the design process itself.
So moving from being a referee to being an architect.
That's a great way to put it. This innovation is the key to maintaining their moat in a world of exponentially increasing complexity.
And that direction seems to lead right to the owner mindset we see in their R&D budget.
They show tremendous discipline. R&D spending is consistently high, around 30% of revenue. That is a massive, sustained commitment. Management sees R&D not as an expense to be cut, but as the essential cost of widening that moat.
And the executives are aligned with that goal, right? Their compensation is heavily weighted toward equity.
It is. This is a hallmark of high-quality tech management. Their financial interests are directly aligned with long-term stock performance and strategic goals. They're incentivized to deploy capital rationally, which they've done brilliantly.
Let's delve into that rational capital allocation, because this is where they avoided the growth at all costs trap of the last decade.
They absolutely did.
Yeah.
And the result is a remarkably pristine balance sheet. When we look at how they use their cash, it follows a clear, rational hierarchy that any disciplined investor would love.
Okay, walk us through that hierarchy. What's priority number 1?
Priority 1 is always that heavy, organic R&D reinvestment we just talked about. You have to continually innovate to stay ahead. Priority 2 is strategic, bolt-on acquisitions aimed at expanding their total addressable market, their TAM.
And these acquisitions aren't just for buying up more of the EDA market. They're venturing into fields that seem totally disconnected.
That's what makes them so interesting. Take the acquisition of OpenEye. OpenEye is in molecular biosimulation for drug discovery.
Right. How on earth does designing a chip relate to designing a drug? It seems like a huge leap.
It is, but the core competency transfer is profound. Chip design is fundamentally about optimizing a massive, high-dimensional problem space. You're modeling complex physical interactions under extreme constraints.
Power, area, performance.
Exactly. Drug discovery is an analogous computational problem. You're optimizing the interaction of molecules under the constraints of biology. Cadence is applying its world-class expertise in complexity modeling from silicon to biochemistry.
So if they can successfully port that framework to design drugs digitally, that's a massive market expansion.
A massive, largely untapped TAM expansion into a trillion-dollar industry.
Okay, and the second acquisition, Beta CAE, that seems more about expanding horizontally.
It is. Beta CAE expands Cadence's focus from designing the chip to analyzing the entire system. We're talking thermal performance, aerodynamics, structural stress for major industrial customers, car makers, aerospace.
So it puts them in competition with companies like Ansys.
It does, but it diversifies their exposure beyond pure silicon design. It's a very intelligent move.
And priority number 3 in that hierarchy.
Shareholder return. This is mainly through consistent share buybacks. And they're disciplined here too. They use them to offset dilution from equity compensation and to return excess cash when other opportunities aren't there.
Okay, so management passes the test. Let's look at the numbers. The financial fortress. What's under the hood?
The financials are just a crystal clear reflection of dominant software economics in a protected duopoly. Profitability is exceptionally consistent. Gross margins consistently hover near 90%.
90%.
That's the definition of high-quality, sticky software revenue. The marginal cost to produce another license is basically zero.
And when you have that kind of gross margin, it creates massive operating leverage as you scale.
Immense operating leverage. And you see it in the numbers. Over the last decade, operating margins have climbed from around 30% up toward the mid-40s. Revenue is scaling much faster than their operating expenses.
So let's talk about the 2 ratios that analysts always point to for high-quality compounders. Return on invested capital, ROIC, and free cash flow conversion.
Cadence is a star performer here. Their ROIC is consistently above 20%. For context, just sustaining an ROIC above 15% is tough for most businesses.
And they can do this because they're not capital intensive.
Exactly. And that leads right to their exceptional free cash flow conversion. Net income converts efficiently to free cash flow because their capex is so low, they sell software, not factories. This makes their cash generation smooth and reliable.
And finally, the balance sheet. They keep it conservative.
Absolutely. The conservative balance sheet is a strategic buffer. Their net debt to EBITDA ratio is usually below 1.0x. This is a team that ensures they can weather any downturn or geopolitical risk without scrambling. The financial fortress is exceptionally sound.
So we've established the financials are pristine, the moat is widening, management is rational, but that just takes us back to the biggest question of all.
Can they outgrow this valuation?
Exactly. Let's get into segment 3, growth vectors, permanent risks, and the valuation puzzle.
And that's the critical hurdle. Cadence typically trades at a hefty premium, historically in the 40 to 60 times price-to-earnings range. The market willingly pays that for the duopoly safety, the recurring revenue, and the AI exposure.
But today, with all the AI euphoria, that premium often pushes even higher. What's the fundamental risk here?
The price. Simply put, the price is the primary risk for investors today. When you're paying consistently above, say, 70 times earnings, you're baking in expectations of nearly perfect execution for 5 or more years just to break even on a valuation basis.
The quality of the business isn't in doubt. It's the price you have to pay for it.
The price demands a faultless future.
So if we accept that, where does a disciplined, long-term investor find that margin of safety for a company like Cadence? It's not going to be in a low PE ratio.
Correct. You are never going to find this stock in the bargain bin unless something is fundamentally broken. The true entry point, the window of irrational opportunity, is typically found during a semiconductor cycle panic.
Explain that disconnect. Why would Cadence drop when the industry panics?
It's a market behavior thing. When the market panics about a potential chip glut memory prices dropping, PC sales slowing it aggressively sells off the pure-play chip companies. NVIDIA, AMD.
And Cadence gets dragged down with them.
It drops in sympathy because it gets lumped into that broader semiconductor bucket. And this creates an irrational opportunity because, as we established, Cadence's revenue is tied to R&D budgets, not chip sales volumes.
And R&D budgets are sticky.
They're incredibly sticky and stable. Major tech giants might delay a factory, but they will not cut R&D. That's sacrificing their future. So the stock falls on sales cycle fears, even though its subscription revenue stays insulated. That's the moment to look.
That's a key insight. Okay, now let's talk about the growth vectors they're counting on to justify this premium. What are the core engines?
The primary engine is the expansion of AI-driven design, or what the industry calls EDA 2.0. This is the integration of tools like Cerebrus directly into the design flow.
And this isn't just marketing, it's a necessity.
It's a necessity driven by physics. When you get to billions of transistors in 3D stacking, the complexity exceeds what a human can manually optimize. Cadence's AI tools become mandatory.
Which lets them upsell customers significantly.
That shifts the pricing dynamic.
Right.
The tools are no longer a cost center, they're a mandatory revenue enabler.
And let's revisit that big M&A play, OpenAI, as a TAM expansion into biological simulation.
OpenAI is probably the highest risk, highest reward catalyst. If they can successfully leverage their computational design expertise and port it to molecular biosimulation, the potential is transformative.
Moving from hardware architecture to molecular architecture.
Right. If they can streamline drug discovery by offering EDA for drugs, they unlock a market that's orders of magnitude larger than their traditional one. It's an intellectual arbitrage play.
And the other one, beta CAE, expanding into system analysis.
That's a more immediate, less speculative expansion. By analyzing the entire system, thermal, aero, cooling, they become critical suppliers to industries like automotive and aerospace. It diversifies their revenue away from just the silicon itself.
We have to address the permanent impairment risks now, the downside scenarios. The most immediate one is geopolitical fracture.
This is the elephant in the room. Cadence gets about 10 to 15% of its revenue from China. A complete mandated decoupling, a total ban on selling U.S. software to Chinese entities.
That would immediately and permanently impair earnings growth.
That revenue would just evaporate. And given the escalating nature of U.S.-China tech tensions, this is not a fringe risk. It is highly plausible.
Another risk is customer consolidation. The customers are getting bigger and more powerful.
That's a growing leverage factor. You have these massive tech behemoths, Google, Apple, Amazon, all designing their own silicon now. Instead of dealing with dozens of smaller firms, Cadence is negotiating with a few giants.
Who have immense financial leverage.
And that allows them to potentially demand custom, lower-price licensing terms. It could slowly erode Cadence's pricing power over the long term.
And finally, the existential risk. The open source threat, often tied to RISC-V, the Linux moment.
We have to consider it, even if it's remote. RISC-V is an open source architecture. The possibility of high-quality open source EDA software merging could, in theory, erode the duopoly's pricing power.
But the complexity of the tools for advanced chips is just astronomical right now.
It is. It requires billions of lines of verified code. So the threat is contained for now, but it's a structural risk. If the trend toward open standards continues, it could chip away at them decades down the line.
Let's run the red team challenge now. Let's invert the bull case. The common market view is that Cadence is a safe, indispensable toll booth on the road to AI.
That's the consensus, and it's mostly correct. But the deep contrarian view offers a different wrinkle. The market ignores that the physical slowing of Moore's law is the very thing forcing the industry toward these highly complex 3D IC designs.
So the problem is actually the solution for them.
The irony is powerful. This physical limit, which might slow down a fabrication company, increases Cadence's moat. Designing in 3D is exponentially harder. It requires superior integration software.
Which makes their tools even more indispensable.
Exactly. Complexity is not a headwind for them. It is the ultimate growth driver and moat widening mechanism.
But the deepest challenge, the one that touches on obsolescence, you call it the Kodak warning.
Yes. The Kodak warning asks, what if the paradigm fundamentally shifts? Currently, the reliance on decades-old legacy code and the deep human expertise needed to master it is Cadence's strongest defense.
But that legacy code could also be an anchor.
It could be an anchor if a truly revolutionary technology emerges. If Cadence's AI advances to a point where a new black box AI native model can design chips better, faster, and cheaper.
Then the moat built on legacy skills and scripts could evaporate.
Much faster than anyone anticipates. If Cadence is busy perfecting the film process and an AI-native startup develops the digital camera, the switching cost moat becomes worthless because the underlying methodology is obsolete.
This is why DevGen's generative design initiative is so critical.
It's everything. They must prove they can leap to that new AI-native paradigm internally, ensuring their R&D spending is a defense against disruption, not just polishing a legacy system.
That's a fascinating way to frame the challenge. The very human capital that locks customers in today could be the source of inertia tomorrow.
It forces us to ask if they can successfully transition from being master of the legacy environment to leader of the new autonomous one.
Okay, let's wrap this up. What is the concentrated essence of the bull case we've discussed?
The bull case for Cadence is built on 4 pillars: inevitable technological demand, powerful duopoly status granting pricing power, massive AI tailwinds that increase complexity, and highly disciplined financial management.
And the corresponding bear case.
The bear case, conversely, relies almost entirely on the current valuation risk, that the price demands too much perfection, and then those structural risks like geopolitical decoupling and the increasing leverage of their big customers.
So the big lesson here is about understanding the quality of the revenue.
The most important lesson, I think, is focusing on the stickiness of R&D budgets versus highly cyclical chip volumes. If you want to own this wonderful business, patience is key. You have to wait for the temporary cyclical panic in the broader market that allows for an opportunistic entry point.
Right. Don't chase the stock at peak AI euphoria. Perfect. And now, the final provocative thought we want to leave with you, the listener, to mull over.
We've established that the shift to complex 3D IC design makes Cadence's software more necessary than ever. But consider this. If Cadence's AI tools, their generative design initiatives, succeed in making chip design truly autonomous, where the AI makes the core decisions and requires far less manual human intervention, does that success eventually make the human engineering skill and expertise, which currently locks customers into the platform, obsolete?
So if the AI is perfect, the need for years of specialized human training erodes. And if that happens, does the primary high switching cost moat, which is fundamentally built on human difficulty and expertise, slowly evaporate? That is the ultimate paradox of extreme automation on a competitive moat.
Something to think about, indeed.
Absolutely. Thank you for joining us for the deep dive on Cadence Design Systems. We'll catch you next time.